Hello, everyone, and welcome back to another session on this week's Money Show Virtual Expo. As always, it's wonderful to have you all here. Now, without further ado, please join me in welcoming our next speaker, Kathryn Rooney Vera, Chief Investment Strategist at StoneX Group, a leading financial services firm that provides global market access and customized solutions across asset classes. Kathryn has over 22 years of experience in global economics and investment management, and she is here today to share some of that expertise with us. So to our live viewers, please type any questions you may have into the chat box. Time permitting, we'll do our best to get through some of those at the end. And with that all said, Kathryn, I will hand the mic on over to you now. I'll be right here if you need me, but the floor is all yours.
Thank you, Charlotte, and thank you, MONEYSHOW, for the invitation. It's my pleasure to address your audience, and definitely please ask the questions. I will make sure that we get to them and even throw them in the chat to Charlotte as I'm speaking, because questions and comments and difference of opinion are always welcome. So the way I'm looking at things at the moment is that the U.S. economy is, by the data, not on the precipice of recession. That is the big question. Are we in recession? Are we going into recession? Are we going to altogether avoid recession? And what I like to show with this visual is just to give you an idea of, over the past 5 decades, how often we've been in recession. It's pretty rare. Recession is in that little quadrant that says disinflation environment. That's negative inflation and negative growth. It's a rarity, but it's an inevitable part of the economic cycle. So my takeaway is, or what I would like everyone to take away from my view, is that recession is coming. It's part of the cycle. The timing of it is impossible for any economist, even the best of us out there, to with precision predict. But right now, what I can tell you is we've lived, everyone here living and anyone listening on this call has lived the majority of his or her lives in quadrant number 2. That's the Goldilocks quadrant. So we are predisposed to consider Goldilocks, which is low inflation, high growth, as the baseline for the economy, to which we should usually mean revert. And my thesis is that the markets are discounting a reversion to this mean Goldilocks. And that's why markets have been moving up so much and have almost completely taken back all of the losses that we saw in the global meltdown. That was very fleeting in nature, but definitely packed a powerful punch. And that was maybe 2 to 3 weeks ago. Leading economic indicators have been a very worthwhile metric to consider when one looks at the status of the U.S. economy. And right now, while still negative year on year, the trend is positive, meaning that leading economic indicators are moving higher. Were they to continue this trend and even go back to positive on an annual basis, year on year, that would definitely back up the soft landing or no landing version of the forecast that many economists currently have. As of now, however, I think that the risk of recession over the next 12 to 18 months is a bit higher than what consensus estimates put it at, and almost certainly, in my opinion, is higher than what the markets, specifically the equity markets, are depicting in valuations and in prices. So the unemployment rate, while still historically low, has moved about 1 full percentage point higher over the past year. There's a rule called the Somm rule, and it was created by a close friend of mine, a professional friend of mine, Claudia Somm, and she developed this rule. And that rule triggered in the month of July. And that rule has historically been very accurate in determining recessions. Now, could this time be different? It certainly can. And Dr. Somm herself has told us and the world in many media appearances herself that this time is different, and that the dynamics that are pushing the unemployment rate higher are not all bad, meaning they don't point and indicate that we're in recession at this moment. So she's saying that her rule could trigger, and it did trigger, but it doesn't mean we're in recession right now. Under the hood of the Somm rule are 2 things. One, firings, and those are certainly increasing, not dramatically so, but definitely increasing. But there's also new entrants into the labor force. And many economists correctly attribute this to immigration. So there's a lot of new people coming into the labor force who, if they don't have a job, they're considered unemployed. So that has pushed the unemployment rate higher, even though companies are not really shedding jobs. It's just we have new entrants into the workforce. Consumer confidence, okay. I would say it's okay. University of Michigan, at least, we've seen some stability there, a little bit on a downshift, but small business is what I look at. And I think that consumer confidence there is worth paying attention to. A lot of what we're going to talk about is the election and that outcome. And I think that is going to have an important policy making approach and framework to how we view the economy and the markets going forward. So inflation, we've heard a lot of talk about that. Inflation is, according to the data, it is 2.6%, and that's core. That means excluding food and energy. So filling up your gas tank, that doesn't count. Going to the grocery store doesn't count. We know that these are probably what should count the most, but this is not the metric that the Federal Reserve looks at most closely. So that metric is 2.6%, of which 1.9 percentage points of that 2.6 come from the consumption of services ex housing. The rest comes from housing. So housing prices would have to drop, or the service prices would have to drop to get to the Fed's 2% target. Right now, we're at 2.6%. In my view, it's very hard to get there without a rollover in the U.S. economy. And why is it so hard to get there? Why has it been so hard? Well, because the housing market is about 1 full percentage point composition of inflation. So it's a very important part of inflation. And what we've seen is a scarcity of houses. And part of this has to do with the Fed keeping rates so low for such an extended period of time. And that's the reality. The Fed kept rates at such an extent, so low for such an extended period of time that about 82% of homeowners have locked in a 30-year fixed mortgage mortgage rate below 5%, and about 2/3 below 4%. So it's a high order to expect people to sell their houses if they have a 2, 3, 4% mortgage rate, when right now they would get a 7% one. And while their house is worth more, they can't afford a similar house because all housing prices have gone up. So certainly this is something that has long been in the making and is making the Fed's 2% goal very difficult to attain. We would need more supply of housing to really unlock the market there. My forecast for inflation for year end is to steady at 2.6%. And I think that's probably where we're going to land in the month of December. The budget deficit is enormous. We have a 7% fiscal deficit versus GDP here in the United States, and that's usually unheard of in terms of this type of fiscal policy making in an economy that's growing pretty strong. The U.S. economy grew 2.8% in the last data, and potential growth for our country is 1.8%. So we're growing above potential. And yet still, we see budget deficits that are pretty high, and that can be inflationary. So let's get into the election repercussions, because I think that's what a lot of people are keen to talk about and to hear our perspective on. So if former President Trump, wins a second term, we should not expect what we saw happen in 2016, and that's what I'm showing in this visual here. The Trump trade, yes, you can play it if you think that Trump is going to win again this year, but we shouldn't expect the same magnitude of surge that we saw in 2016 from financials and industrials, which are the principal two sectors that had the best performance after Donald Trump won in 2016. And that's because that was a total shock to the markets. No one was expecting it. Now, this time around, if former President Trump does win, it will not be a shock to the markets. In fact, I would argue that it would not be surprising at all. So we should not expect something similar, although I do think that financials and industrials will continue to disproportionately benefit from a potential Trump 2.0. And why is that? Because of lower regulation that would come for financials, and because of a different spending, and that would be towards defense and industrials. So those would probably be my top picks. The energy space, I get that question a lot. Energy as a sector would benefit because regulations would come off and the US would reopen closed fields and opportunities for the US to produce energy. While that is good, what it would probably create is additional supply of energy. So when you have supply going up and demand staying the same or even going lower, then that could mean lower oil prices. So I don't have energy as one of my top picks under a Trump administration, although I do think that, and that's the reason why, although I do think that regulations would favor or a decrease in regulations and a less heavy hand in the traditional energy space would be positive for big oil companies. So this chart comes from StoneX Wealth Management area. I am the chief market strategist for the company, but we have a wealth management area, and they did this analysis. They said, okay, let's look at historically what occurs under an all Republican government. That means White House is Republican, Senate and House are all Republican, and what does that look like with the S&P 500? What are the returns like versus all Democrat? And then Republican president with a divided House, or Democrat president versus divided House. And as you can see, it may surprise some, depending on which side you sit, that the numbers aren't too far off. So you can say that presidents don't really matter, or you can say that they're all the same in the end, or you can say really that the markets are based off of corporations making money and delivering shareholder value at the end of the day. And that, I think, is where we need to focus. And so for that reason, we look at the policies that could affect shareholder value and corporate profitability. So what is the biggest impact to corporate profitability from my perspective? Taxes. So what should we expect under a blue wave, which would mean Kamala Harris takes the presidency and the Democrats take both the House and the Senate? We should expect the corporate tax rate to go up. That will go up from 21% to 28%. I say that has to happen under a blue wave because it requires congressional approval to make adjustments to the tax landscape. So if we were to get a Kamala Harris presidency with a divided Congress, meaning the Republicans take the Senate, the Democrats take the House, perhaps. We wouldn't get that. We probably wouldn't get that. We will get a big fight with regard to the expiration of the Trump tax cuts, that's for sure. And my own personal perspective, and I think that's what I'm here to give you all, is that if we do, no matter who wins, I think the Trump tax cuts for those making households making less than $400,000 a year are going to get extended. If President Trump does get elected again, they would be made permanent, in my opinion. If Kamala Harris gets elected, they would be extended for this cohort of people. If there is a blue wave, taxes go up. Corporate taxes go up. Okay, corporate taxes go up. Tariffs, you can see the impact of a Harris plan would be modest in our view. Trump would be, I would say, somewhat higher, not maybe significantly higher. That would be my take on things. The truth is that the first Trump administration, what did we see? We saw an imposition of tariffs that the second administration, Biden and Harris, did not unwind but added to. So, and we didn't see a too big of an impact on inflation, although it should be inflationary. So on tariffs, I think we should expect them from either president, and perhaps an improvement of terms with regard to manufacturing and the relationship with China, improvement of terms on the part of the United States under a Trump presidency. That is my opinion. Green energy, you would see scaled back in a Trump administration and pushed forward under a Harris administration. Regulation is clear. I've already discussed that. And entitlement programs would stay the same on both fronts. Fiscal deficit would likely stay the same on both fronts, just difference in spending. Spending under a Harris would probably be more towards, social spending and green energy, while Trump would focus perhaps more on defense spending and on tax cuts. The budget deficit, no improvement on either front. Okay. 2024 election as it stands today, closer race versus with Trump and Biden, Trump and Harris than it would have been with Trump and Biden. The Senate is currently likely majority in the Senate, and the House, with Harris's addition, probably catches some tailwinds from her addition, because Democrats will go out to vote now, where otherwise under Biden they may not have. So what is the impact on the economy of these policy decisions? So under an all Republican leadership versus a Republican president and a split Congress, let's just look at that scenario. For the economy, tax policy is stimulative. So, and you're going to get a tighter immigration policy. That could be inflationary. That very well could be inflationary, because the economy is already growing at a very good clip and above potential. And immigration is enormous. So if you get fewer workers out there, then probably wages go up because of the supply demand impact. And then on the tax front, lower taxes, whether they be for corporates or for physical people like you and I, are stimulative for the economy. So that would keep the economy chugging along. We wouldn't hit the 2% inflation target. We can argue whether or not that 2% inflation target even is a necessity. And I'm fine to talk about that in the Q&A. But I think if there's a split Congress, you get a more this is intuitive, you would get a more subdued version of the all Republican leadership. You would not get as many tax cuts, and there would be that checks and balances on policymaking. Inflation would probably stay strong and high under an all Republican leadership, and probably under a divided Congress as well. Because really, unless there's some sort of retrenchment in the economy, it's very difficult for an economist like I to see a change in the main drivers of inflation. The main drivers of inflation, as I showed you previously, are consumption of services, ex housing, and housing. So if people still have jobs and they're doing great, and they continue to consume the services that they are, there's no reason to change their habits of consumption. So it's unlikely that we would get any drop in prices for services over the course of the next year or two. With regard to the Fed would probably start to cut. They're going to cut in September, probably cut 25 basis points and cut again in December. And I don't think they're going to cut further than 125, 150 basis points in total. That's 1.5 percentage points from where we are now at 525 to 550. So the Fed probably stays a little bit higher than historically they have been. And rates, probably the short end of rates in terms of treasuries, they come down in the short end and they go up in the back end. Now, this is our wealth management division. I like to highlight them because I think they do a great job with regard to asset allocation. So this is their heat map, the asset class heat map. And it shows you kind of where we stand today versus where we think we're going in the second half of this year. And you can see that there are some risks on the horizons to large cap in the United States. And I'll show you why. Actually, I think I'm going to skip directly to that because it's a very nice lead in. And the reason there is some risks on the horizon is if, in fact, we do get a slowdown in the economy, large cap equities underperform, and they underperform markedly. Now, if you'll recall, we started out this presentation with a similar visual to the one I'm showing now. And in the third quadrant, that says that big red circle that says 2008, that's recession. So in a recessionary period, or in a stagflationary period, large caps do not do well. And in fact, with valuations where they are, it's hard to imagine that in a recession, large cap performs in any way, shape, or form. So what is the way to protect oneself? What I've been recommending against this inherent volatility that I think is endemic in the market, it's not being seen right now, but I do believe that with economic data releases that come out unfavorable, the market will react negatively. How do you protect yourself? You protect yourself with defensive sectors, such as utilities, such as staples, such as healthcare. Those would be my top 3 picks. You protect yourself with positions in gold, which is an asset class that has rallied tremendously. As you can see here, this is one of my top picks coming into this year. Utilities has done very well. Gold has done very well. Industrials, equally weighted S&P 500 is also another one of our recommendations, and that has done very, very well. So the message that I would like to deliver today is, to me, it makes sense when you have so many risks on the horizon that are underpriced, namely an overheating of the economy and a Fed that has to cut and then has to hike again. Potentially, it's a fat tail risk, a recession risk, electoral risk, policy risk, Federal Reserve risk, policymaking risk on the monetary and fiscal front. There's a lot of risks that I think are massively underappreciated. I'm not saying sell your equity positions, but I am saying protect them. And one of the ways that one can protect their positions is with the purchase of options. So you can do this with protective puts, and you can buy protective put options. They limit your upside, but if you let them expire, the only thing that you've lost is the cost of the option. Whereas if the market drops, you're very happy because you're protected. Okay. Fixed income does very well in recessionary periods, intuitively, right? Because inflation drops, economic growth drops, the Fed cuts rates. And as we know, when fixed income interest rates go down, prices go up. So I think it's a good idea to have a position in fixed income. And I'll tell you what, the 60-40 portfolio, that is back. I think it's back. Once inflation drops, interest rates start coming down. They're going to start coming down next month. The 60-40 portfolio will provide you the diversification benefits that it has failed to do in recent years. And why has it failed to do that? It's failed to do that because inflation has been high and the Fed has had very high interest rates. Okay, so what does that tell us? Equity risk premium right now, not that attractive. So the Fed has to cut rates. Cash looks very attractive. I mean, cash yields you 5.3%. And so equity risk premium, doesn't look that favorable. So I think these are some of the risks that we have to have in our minds and on the horizon. And just for the sake of time, because I do want to leave time for questions, I'll close with this. This is the Fed funds cycles and recessions. Now, historically, we see recession when the Fed starts cutting. And on my team at StoneX, on the institutional analysis team, what we did is we looked at the past 7 cycles where the Fed has cut rates. And in 43%, 3 out of the 7 periods, the US economy did go into recession in the next 12 months after the first Fed cut. Okay. The other 4, the US economy avoided recession. Now, it all depends on why the Fed is cutting. Is the Fed cutting because the labor market is rolling over and needs to shore up jobs and the economy, or is it doing it because it's reaching its inflation target? And I think that's the open question. As I have here in this visual, you can see that that now is the crunch time, and now is the time when we're going to see the strength of the economy and why the Fed is cutting. So I would be wary of and watchful for U.S. growth, as well as what I had mentioned, the policy risks on the near-term horizon with the November 5th election coming up. And Charlotte, with that, I think we have 5 minutes left for questions, and I would love to open it up to questions.
Fantastic. We do have a couple of questions here from our audience. I will start with this one from Monica. Monica asks, how would presidential candidate Harris's proposed tax on unrealized capital gains impact U.S. homeowners? And are there any other areas that might be impacted by the proposal?
That's a very good question. Thank you for mentioning that, because I neglected to include that. That's a very important proposal, and it would have an important impact on what we call the wealth effect. So unrealized capital gains is not, of course, something that I, as a market strategist, favor. Nor anyone who maybe has unrealized gains. So I think it would be very detrimental to the wealth effect. I think it would be detrimental to savers, and I think it's an erroneous policy, and I think it could affect consumption as well. because what we're seeing in the economy right now is that the workers, savers, they're the ones keeping the economy strong. So I think that the combination of policies that we've heard, unrealized capital gains tax, increase in the corporate income tax, as well as the subsidies for housing, in my view, this is my personal view, they're a net negative for the economy and the markets. That's my personal view. I think that the housing market, what we don't need right now in a housing market where prices are high and rising, is subsidized housing. Because what happens next? If you're a home builder and you know the government's going to subsidize $25,000 in down payment, what do you do the price of your home? That day, you increase it by $25,000. That's what at first blush, my reaction to that was. I'll tell you what, I don't think they're serious proposals. And I don't think they'd get anywhere in Congress, especially if it's a divided Congress. And if there's one thing I can tell you all with conviction, is that I truly believe there is going to be divided Congress. I think the Senate and the House will be in different hands, and the White House, I really couldn't tell you. But what really matters, I think, is the division of Congress. Is there another question, Charlotte?
We do have a few more here. Next up, we have a question from Gerard. He's asking about inflation. He says, why have a 2% inflation target? Wouldn't we want 0 so that we can conserve our purchasing power?
Yes. So we have a 2% inflation target. Let me get back to we have a 2% inflation target, and that's a good question. It is arbitrary. You know who came up with the 2%? The New Zealand central bank years ago. And now the developed world, we all kind of follow that. So 2% is arbitrary. It doesn't have to be 2%. It could be 1, it could be 3, it could be 5. But that is the target. So the Fed is not going to change their target until we get to said target, because that would be a massive hit to monetary policy credibility. So if we're at 2.6 and the target's 2, and the Fed says, okay, guys, the target is now 3. That's never going to happen. But what the question I think is why not have 0% inflation? Because deflation, if you have a 0% target, deflation is very, very nasty. I mean, deflation is when prices are dropping. So people don't buy today because they know it's going to be cheaper a month from now or 6 months from now. And price deflation is really hard to get out of. So you want to have some amount of inflation, because that's consistent with economic growth. Because remember, we have supply demand. So when you have a lot of demand and people have jobs and they're buying things and they're buying services, then companies see that demand and increase their prices, and that's fair, and that's not price gouging. That's capitalism. So some amount of inflation is okay. 2% is not a lot. But if they were to target 0 inflation, then you're going to have adverse impacts on economic activity, and we certainly don't want that.
Thank you, Kathryn. Next up, we have a question from Kelly. She asks for your views on gold and silver, if any.
Yes. Oh, I love gold. Gold has done fantastic. I think gold, let me just put this back up here. In the market, when the markets dropped 2 weeks ago, gold dropped. And I thought, now's the time to buy, because gold just keeps going up. So what's happening with gold? I'm actually going to reference one of the charts that I skipped, because this is such a good question. So what's happening with gold here is that China's buying fewer treasuries. They're buying more gold. Saudi Arabia is buying fewer treasuries. Russia's buying fewer treasuries. They're buying more gold. So this run up in gold has been fostered by central bank purchases. Now we're seeing retail guys and gals get into the game. So I think there's further upside. I like gold. I think it's an inflation hedge. I think it's a risk hedge. I think it's an important hedge to have in a portfolio. So if you have it, hold it. And if you don't have it, whenever there's a market sell-off, I would say let's dip into the gold trade, because like you can see here, the deficits are very high. US debt is on a very, very strong upward trajectory. And so I think gold is a nice safe haven play.
All right, let's see if we can squeeze one more question in here. I've got one from Gregory. He asks, how would a 33% increase in corporate taxes affect the economy and Americans?
Well, the corporate tax, if it goes up, I've done an analysis that shows the S&P would probably decline somewhat, but the more important component that I see is the impact on jobs. Because when a corporation or a physical person, when we have to give more of our money to the government, whether it be a company's money or our own money, then that's money we don't have to save and invest. And that's money the corporation doesn't have to invest in equipment or capital or human capital. So you increase corporate taxes, you could have cost cutting in other ways. So that's where I am most focused on that impact. I think there's other ways to curb the deficit, and that could come from curbs on spending, which is something that's not often discussed, but should be, rather than increases to taxes.
Well, Kathryn, thank you so much. That does conclude our time for this session. Thanks for a fantastic presentation and for getting some answers into those audience questions.
My pleasure. Thank you very much. Goodbye.
Of course. And another big thank you from those of us at Money Show to you guys watching us live at home. Be sure to stay tuned as we do have one more session in store for you today in this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.